you may be looking at your super fund and you may see alternate assets. It's actually a pretty sexy word, isn't it, Vince Scully from
I love
Life
a bit of an alternative.
Are you a bit alt?
I was in the 80s and 70s. That was pretty alt.
Yeah, but here we are. The word in the investing world, it probably has moved very far from where it started, right?
It has,
Back in 1962.
Yeah. I mean, alternate used to mean not a share and not a bond. And it sort of morphed on from there. And it does depend on where you sit in the world. So if you were an American asset consultant, you would consider infrastructure, real estate, private equity, all to be alternatives. I'm not sure the average Australian super fund would put either of them or any of those in the alt basket. But the whole point, I think, of an alternative is if you want to get a different result, you have to do something different.
Yes.
So if you want to do something different to a traditional 60-40, 70-30 portfolio, you've got to do something else. And what is it that you do?
So in terms of, if we fast forward to today, I'm going to draw my little pie chart. I've got a corner of the pie, which is Aussie equities. I've got the next slice of the pie, which is international equities.
Global equities, yeah.
And listed, mind you. We'll say listed for this example. There might be another corner that is cash and bonds.
Yep.
Okay. So the rest of the pie chart is now, quote unquote, filled with alternatives.
Everything else is alternatives.
Everything else. Now, within that, property.
Yeah, so they're all real assets, being infrastructure and real estate, would in many cases be considered alternatives historically. And that's sort of to move away from the old-fashioned, if you wanted to tone down the risk in your portfolio, you used to buy some utility stocks. So you buy the power company and the phone company.
There's one on each corner of the Monopoly board.
For
a
very good reason. And that, utilities investing was for granny's portfolio, stable dividends, backed by regulated cash flow, beautiful things. And that's obviously grown as infrastructure investment is become a bigger and bigger deal. But when I started selling infrastructure at Macquarie in the mid-90s, it was considered very unusual. And we were running around trying to tell fund managers, well, it's just like real estate and it's sort of like a bond. And so everyone was going, well, okay, well, therefore I should hedge it. And so you got this flurry of hedged infrastructure funds.
So in a modern day portfolio, and call it your average punter's super portfolio that's pre-mixed or whatnot, they would have the sectors that we've talked about. They would have a lot of unlisted property, your shopping centres, your
all listed, mixture
warehouse, all that stuff. Another alternative that we can talk about would be, and I'll share some examples shortly of some top super funds in Australia, what they consider alternative, but a lot of them are just VC, venture capital funds.
So I think in
high risk
in an Australian
punting.
context, private equity tends to be lumped in with equities, and rarely would you find it under a label alternatives. Whereas if you look at a US endowment, like the Yale endowment, for example, which is the poster child for alternative investing, they would have real assets, private equity, venture capital, would all be in their alts bucket.
Yeah, so for example, actually I'll go there now.
And David Swenson is the
first one that I looked at, Aware Super, disclosure, they have sponsored episodes and ads on the Retire Right podcast. They're publicly, and this is publicly available on their website.
You just download the PhD and it's there.
The PhD?
The Portfolio Holdings Disclosure.
Gosh, haven't heard that one for a long time.
We live and breathe it at Life Sherpa.
Yeah. So they've said they've invested in Canva.
Yep.
They've invested in a company called Safety Culture. It's a workplace safety and operations platform. It's an Aussie company. They've invested.
This is in their private equity
Yes.
allocation. Yep.
Yep. Propeller Aero, a drone mapping and analytics firm for construction and mining. Nitro Software, a cloud guru before it was acquired by Pluralsight. Now, there's a few others there, but I think, and this is the interesting thing, if you are investing as an angel investor or, startup seed capital, it's a company that's effectively a very low cap company, right?
Yeah, it's just a small company with limited track record.
And this is the difference. Is it much different from a penny stock?
Probably not. The advantage from a professional investor perspective is that you probably have better access to information. So if you're and this is one of the things that, as a principal investor in infrastructure, that, you were potentially sitting on the board, you got all the accounts, you were able to engineer a refinance and pocket the benefits. That's a great way to make good money. You put a third-party manager or 2 or 3 managers between you and the money so between you and your super fund, there'll probably be so I would probably suspect that some of those private equity or venture capital investments were through another manager, maybe as a limited partner in a fund. So you're starting to get remote from the information, which makes it difficult for you to make an informed decision.
And I think what I want to get to is, or we might move along to the other bits of the pie, but to me, and that's where the language has changed, I just see investing in a startup, well, you're just investing in a unlisted company.
So it's private equity, but
but it's now alternative.
Yeah, David Swenson would categorise that as alternatives
because it's not the norm. Most people aren't doing that. So other bits of this
commodities.
Commodities, yeah. So you can invest in, and they're predominantly like futures, aren't they? Like,
we're big fans of physical gold.
Yes.
So in a Life Sherpa portfolio, you will see an allocation to gold, and that's the only direct commodities investment, because I think gold, and to a lesser extent silver, sits different to traditional commodities like wheat, soybeans, orange juice, pork bellies,
oil, coffee,
which tend to be a bit more of a trading opportunity or an inflation hedge. Whereas,
you could look at currency as well.
Or currency, yep.
Which, and then I guess finally new entrants in town, there could be like cryptocurrency or Bitcoin.
Yep.
We'll talk about potentially art. Could be fast cars, you name it. The more alt you get and the more that you leave the group, the wilder the West is.
Yeah. So, from an Australian context, alts would typically be things like on a financial market, so setting aside Pokemon cards from them, you'd be looking at things like absolute return funds where you're maybe have some borrowings, you might be selling short, you might sort of, buy Rio, sell BHP with a view to not taking market risk and trying to build a trade. So absolute return strategies, hedge funds, private debt or credit, they would often be in the alternatives bucket.
But most people, most of the time, the heavy lifting in their portfolio is from your equities, bonds, and property.
Yeah.
A bit of infrastructure.
And infrastructure. Yeah. Infrastructure and real estate are sort of interchangeable. They serve the same purpose in your portfolio in terms of delivering strong GDP-related, inflation-related growth, highly regulated monopoly markets.
Well, you look at Transurban, they've got contracts, particularly with state governments.
Yep.
Here's the toll, it's inflation-linked for the next 20 years.
Yep.
Not going anywhere.
And so that's a real big stabiliser in your portfolio. Broke down a little bit during COVID because, of course, we all stopped driving to work and airports closed. So, but that was alternative. Today, I think that's pretty mainstream.
Yeah.
So if you look at your typical Aussie super fund, bonds, equities, real estate, infrastructure. That's the core. Then you move beyond that and you go, well, what have I got? I've got commodities, I've got credit, I've got absolute return strategies, hedge funds, currencies, commodities.
Well, we're going to talk about all of that and some other little sexy stuff. This episode is brought to you by, we'll do Life Sherpa Invest again today. Why not?
Well, since I'm here.
Since you're here, tell us elevator pitch, Life Sherpa Invest. What is that?
So Life Sherpa Invest.
And who's it for?
Life Sherpa Invest is for people who want to get invested but don't want to spend half their spare time managing the portfolio. For them, investing is not a hobby. It's something to get their money working. And we have 4 risk-based portfolios that you can buy from $5,000, do it all online, predominantly indexed and low cost. And it's the same portfolios our advice members have been getting for over a decade now, and they're now available from $5,000.
So it's a full portfolio solution.
Yep. It consists of about 9 components: standard, ETFs, Australian equities, global equities, emerging market equities, real estate, infrastructure, gold, bonds, and a couple of small cap managed funds, which add a bit of return.
So that is your IP, your portfolio sitting on the Open Invest platform.
That's
awesome.
Right. So Open Invest issues the PDS, deals with all the online processing, ID, compliance, audit, tax reporting, transacting. So you get the benefit of bulk transaction pricing, and it's our IP.
Yeah, awesome. Full disclosure, I do have an account myself.
So do I.
Vince Scully from Life Sherpa, welcome to the show again. You're listening to Money, 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 or as the regulars like to call us, M3. Everything discussed on the podcast is general advice only, which I'm licensed to give, and details can be found in the show notes. My name's Glen James, former financial advisor, now podcaster. I host this show and a show called Retire Right. I've also got a book called The Quick Start Guide to Investing, which you can check out wherever good books are sold, or there's a link in the show notes. Otherwise, thanks so much for listening today. Now on with the show. Remember, if you are new to investing and you want to get started, I've got a book, The Quick Start Guide to Investing. It's really good.
It is. It's quick.
It's quick. And it's a start.
And it's investing.
And it's investing. It's all that you could want. You can get that wherever you get your books. There's a link in the show notes. We'll talk about maybe some of the sexy stuff the second half of the podcast, but I want to really talk about the alternative thing. I might finish just as an example. I was looking, and this is interesting because I think this whole private equity thing, there is one asset class that, and particularly I think it's true, when they say past performance isn't an indication of future performance. If you have a seat at the VC table and they're coming to you first with deals and you've got a private equity fund, you've got a very good track record because you've had the first bite of the cherry in that fund for putting money into deals.
Yeah. I mean, there is a fair bit of evidence of, persistence of manager outperformance in the private equity space. That doesn't necessarily make it a good investment, but if you are looking at areas where the manager adds value persistently, then private equity is one of them.
Because if there was a private equity fund, as you could invest your money in, it's almost like the whole professional soccer team, or whatever the sport is, lock a junior in for 80 grand for the next 5 years, turns into a superstar in year 3, you got a really good deal on your hands. And I think it's very similar.
Yeah, it is.
With, we've got 10 horses here, throw money on all of them. The 1 or 2 that are winners and that are unicorns are going to go out of space, and it doesn't matter what the other ones do.
Yeah, and that's probably the challenge, that to identify a manager with persistence and, that they've got more than one unicorn.
Yes.
So there are so many people running VC funds founded by people who did a startup and made a lot of money, and now they're suddenly VC managers.
But that's
and then
the
there are
biggest trap.
professional.
I do something, I have success at it, I'm good at it, I'll go and do it over here and I suck,
Yeah.
or do something else and I suck. No, I got lucky over here.
Yeah. And so, there is an opportunity there. The evidence is not strong that there's persistent outperformance for risk since the GFC. There certainly was leading up to the GFC, so the Yale model worked really well until 2008.
So I looked on, again, another super fund just as an example, and I will do ones that I haven't taken money from, but Australian Retirement Trust, disclosure, they've worked with the podcast before. They've got a partnership with Airtree Ventures.
Yep.
They've put money into Canva, Employment Hero, Go One, it's an online learning platform, Pet Circle, an online pet supplies retailer, and Linktree. Now,
Great Aussie startup.
and then let's have a look. This is interesting. Rest Super, okay, I haven't taken money from them, or they've not worked with us. They invest in private equity, but they do not publicly disclose specific startups. So it's not clear. So that, you're big with your spidey senses on transparency.
Yep. It's a really important function if you're investing, which is why we spend so much time looking at these portfolio holding disclosures.
Host Plus, I've not worked with them before. And this is interesting, like these same names are coming up.
Yeah, so Host Plus outsource 100% of their investment. So almost all of their...
Yeah, like Blackbird, Square Peg, and Airtree.
Yeah.
When I think, if I was reading it right, I don't know if Aware Super go direct or not. Not sure.
They do have some directs.
Yeah. But I think what I'm getting at is, so you look at Host Plus where they've put money into Canva, Safety Culture, Go One, Linktree, Pet Circle.
Yeah.
So if you're...
Pretty quiet about the ones that didn't work.
Yeah, that's right. Is there a story there?
Well, what was the big Aussie super wrote $1 billion off? What was that company?
Yes.
Some education company?
Yeah, Early Learning, or I forget. We should know off the top of our head. Having said, probably should have looked at Australian Super as well, though. Having said all that, if you're a VC fund like Blackbird or Airtree, and you need money to put into your funds or into startups, you're going to the biggest pot of money in Australia to try and get some, right?
Yeah,
So I think
it's
all that to kind of bring this home. A lot of our super portfolios, you will have access to these alt investments, even if it is 0.5% of your total fund.
Yeah. And, of course, they need to be making big decisions. So if you're managing, $150 billion, you sort of have to be making $200 million, $400 million decisions. And so you need to go into a pooled fund.
Well, this article on the Australian, Host Plus turned 94 million into 1.9 billion with Canva. So, I mean, the getting's good while the getting's good, but this is why we don't put 90% of our wealth into unicorns, because for every alternate unicorn, crypto coin, meme coin that goes to the moon, there's probably thousands.
Yeah, because that's how the model works. The idea is that you throw enough mud at the wall and the ones that stick pay for all the other ones. That's not to say it's bad. It just means that you need to make sure that your manager is going to find the one that sticks, and that's hard to do up front. But I think that's sort of a relatively minor part of the old story. So when you get into things like hedge funds.
Yeah, so talk to us about, as an investment, how do, if you're doing that pitch, how does a hedge fund work? That we go and collect money from investors, we invest into the portfolio, and they go hedging.
Well, I mean, the original word hedge fund came from the fact that they used to hedge. That it was designed to give you a different result. And So the whole
A result
point-
that wouldn't correlate to the
so
main
the whole
vibe.
point was that you're going to get something that doesn't look or smell like an equity bond fund, right? And the pitch wasn't always, we'll get you more. The pitch is, we'll get you different. And that's where a lot of the comparison falls down. So the famous Warren Buffett bet, great PR stunt where he bet this hedge fund manager that the S&P 500 would outperform whatever hedge fund was picked. And they picked an index of hedge funds, which is the exact opposite of what you think about indexes for equities. So if the point of a hedge fund is to get different, if you take an index of hedge funds where you average out all of the hedge funds, what you end up with is all the different hedged away and you're left with the cost increase. So of course it's going to underperform.
Yeah.
But the point of a hedge fund being you want to get something different. Now, why would you want to get something different? Well, if you're if you make your living as a equity fund manager, you probably want to be investing your own money in something that's not dependent on what the stock market does. If you're a real estate agent, you probably don't want to be investing in residential real estate. You want to get something different to spread your risk.
Yeah, if I'm a construction worker, do I want my super with CBUS?
Yeah.
I don't know.
Yeah, that's a really good point. Yeah, so do you really want all that big portion of your retirement savings
In your bread and butter.
invested in construction where you get your job? Maybe not. Tell that to all those Enron employees who
We had the share purchase plan.
in their 401k or
Yeah.
super fund. So it's about getting something different. Now, does the average punter need something different?
Maybe.
Probably not.
But if so, that's where we go to, well, that small difference, is it an investing strategy play or is it a hobby/interest?
Yeah. And so we don't invest in hedge funds at Life Sherpa.
But so what you're saying, there's probably been a little bit of mission creep from the traditional hedge fund
Yeah.
to the hedge fund of Wall Street today.
Yeah. So a lot of what you would call a hedge fund for most retail investors today is really a fund that can go short, that is sell stock they don't have in the hope that it's going to fall in value, that it can borrow, so it could be geared, a long-short fund geared, something that's focused on an absolute return, maybe trading options, futures. A lot of those would get caught in the hedge fund definition, and that's not quite what the original answer was. And so Yes, we'll go.
Yeah, just out of interest, I just had a look. Warren Buffett's famous hedge fund bet was $1 million wager he made in 2007 against a New York hedge fund firm, Protege Partners. Buffett, a simple S&P 500 index fund, specifically the Vanguard S&P 500 ETF, and Protege side, a handpicked portfolio of 5 hedge fund of funds.
Yeah.
Okay.
So fund of fund. So now you've got double layers of fees.
I'm thinking Horizon 4. And
Yeah. And so if you'd done that bet 10 years earlier, so if you took the period from 2000 to 2008, you got a different answer. And as I said, taking a fund of funds times 5, what you've done is arbitrage away all the difference, and you've just ended up with an expensive equity fund.
So the cumulative outcome was to the S&P 500 plus 125%, where the hedge fund basket was about 36%. So
but yeah, roll that back a decade previously, and you got a completely different answer. So, but the point is, you're not looking for better, you're looking for different, and that's often not a requirement for most retail investors.
So in this climate, when we're now saying basically property and infrastructure is pretty much normal now.
Yeah, I would call that normal.
In most pre-made portfolios in a super fund, the razzle-dazzle, is it VC? Is it just more equities, unlisted?
Yeah. So,
Because a lot of these big super funds, Vince, they're still not touching gold in their portfolio.
no, I don't think there is a major super fund in Australia with a significant physical gold holding.
Why do you think that? Is it a trustee weird quirk that we like, or do they not do any type of other commodities? Like they don't do oil futures or currency funds?
You don't see very much. You'll see it buried in some of the absolute return strategies, but you won't see it stick out materially in a portfolio holdings disclosure. It's a bit more specialist. It's more expensive.
I guess, yeah, the thing is with, the reason I'm using big super funds as a bit of a anchor to this discussion is because most people will have their money in a big super fund, right? When it says much more money, it's like, well, why don't they just go and buy the gold ETF? Well, they're not going to be buying retail, these big super funds, are they?
No. But there are...
But you'd be able to get wholesale. Surely, if they rocked up with $1 billion...
Yeah, if they rock up to...
some place in London.
Yeah, the LBMA, and you could buy tons of the stuff. But I don't see it happening. You see it a bit more in the US, but you don't see it here. Whereas here it actually makes more sense. So gold for an Australian investor, or at least anyone who lives in a commodity currency, so Canadians, South Africans, Australians... Gold gives you this double whammy. So anyone who's getting their personal finance content from US creators, you'll get a completely different view on this. But for an Australian investor, you get a double whammy. So first of all, by investing overseas, when the world gets recession or world prices start falling, the Australian dollar falls because people run to the US dollar for safety. And generally when recession happens, commodity prices fall, which further pushes the Australian dollar down. And investors also look to gold for safety, and gold's priced in US dollars. So you get this double whammy from gold as a protection against volatility.
Of the currency.
Well, because as an Australian investor, you want overseas investments to protect you against the fall in the Aussie dollar, or to give you an upside from a fall in the Aussie dollar, which sort of smooths out your global exposure. And then you get an extra oomph because the gold price goes up when global markets go down. And so it gets amplified because it's priced in US dollars. So for an Australian, South African or Canadian investor, gold's a really important diversifier.
And maybe the big super funds, they don't touch it because maybe a lot of their portfolio theory is from the States. I don't know.
Yeah.
You wouldn't think so. That's a question. I'll ask BP next time he's on the show.
I mean, I think it's a bit of a historical thing. And, they will all have big exposures to gold miners, which behave somewhat the same, but with a lot more equity volatility.
So when it comes to, and I'll just, for those, you've mentioned a couple of times the absolute return funds.
Yeah. So
now these, as far as I'm concerned, they operate differently because the objective is the whole benchmark is CPI plus X.
Yes.
And we'll do that in a way that will not look like your normal fund.
Yeah. So you're trying to deliver a return without it coming from market movements. So a typical way of doing that is to look at a market neutral strategy where you might have a view that you could trade bank pairs. That's often quite a good one, where you might buy NABs and CBA and short Westpac and ANZ and switch as the market changes. So that's a return that should be independent of whether the market goes up or down. And there are typical strategies like that. They can be options trading strategies.
The problem is, the fees for those funds can look a bit naughty.
Yeah, but it can give you stability. There's not a lot of evidence that the stability benefit outweighs that cost benefit. So we're not absolute return investors at Life Sherpa.
But if you're a true believer in drinking the Kool-Aid and living it and breathing it, and you understand it.
Well, it's the understanding is the hard part
Yeah.
because the most of the managers are trying to protect their IP in quotes, and so your disclosure is limited.
Well, and this is it. Like with these absolute return funds, they will look different than your standard balanced portfolio that will have. I'll make something up for the example, but a super fund will say the strategic asset allocation will be Aussie equities 25 to 30% at any one time. But the absolute return fund might say at any one time Aussie equities might be 0 to 90%. So they've got more levers to pull.
And they will usually be able to go short and long, which is, to me, one of the markers of a hedge fund today. Means it's got gearing, it can go short, and it can, so you could have often they're claimed to be like 130-10, where they might go long, have greater than 30%, so 130% of the money exposed on the long side and 10, 20, 30% on the short side to try and give you a more stable return. Usually the fees tend to outweigh that, unless you're looking for something particularly different, in which case it doesn't really matter. So it all comes back to what are you trying to achieve with your investment? And when it comes to our super funds, what we're trying to do is pay for a retirement which could be 40 years long and 30 years in the future. And so your biggest enemy is inflation. And your ability to save.
But it's interesting though, like you see a lot of, if not all, of the big super funds at the moment in their PDSs, with even their off-the-shelf pre-made portfolios, the language they're using looks very absolute return language, where the target is 4.5% plus CPI. And that wasn't around 15 years ago. Now, I don't know if it was an APRA disclosure thing or a marketing comfort thing.
I mean, it's sort of a good way about thinking.
Because, it's a better way to understand that, no, this portfolio is targeting inflation plus 4%.
Yeah. Now, they're not buying things that are designed to give specific CPI plus returns, but it's a good way of picturing that a 80, 90% growth portfolio should be delivering you CPI plus 4-ish maybe.
Yeah.
Whereas if you're going to take a 50% growth, you might be looking at CPI plus 2. And that's a good way of mentally thinking about the future, that my trade-off for this lower volatility is lower real returns.
And I say this almost every time I get a microphone. It just so annoys me when I see other money influencers on Instagram and TikTok where they say, if you just invest $500 a month for the next 30 years, you'll have $12 million. Nah, you won't. They don't discount it for inflation.
Or tax.
Or tax. Or fees.
Or fees, yeah.
Because
you can't actually buy the S&P 500.
No. It annoys me that it's giving people false hope, because what if you're like, they said, just put $500 a month, after 10 years I'll have 200 grand. They said I'd have 200 grand, but I've only got 97 or whatever it is. I don't know.
But I think the whole getting that CPI plus concept in it, I think, is a useful way of thinking. But that's not how the return turns up. So it's because the market delivers the returns.
So I guess before we move to some sexy assets, if you will, anyone, if they hear the word alternatives on the street with their super, it's basically going to be private equity.
Yeah. Private credit.
Private credit. Now, just quickly, the private credit.
Now, private credit's an interesting one. So the private credit is effectively a deal between a lender who's not a bank and a borrower.
So when I used to work for a firm, when I started my career, we had a lot of high net worth clients and, 20 mil plus. And back then that was a lot of money. Probably still is at the moment. I'd take it. There was a lawyer that they would use for their high net worth clients that other people would come to them and say, we want to borrow $1 million for a mortgage. The lawyer would talk to our office and say, have you got any clients that, wants to put $500 or $1 million into this? The lawyer manually does a contract.
Yeah.
And then that's literally the private credit.
Yeah. So that,
and it's coalface.
Yeah. So the traditional solicitor's mortgage fund, which is what you're talking about, is a long way from the true private credit market. And you do need to distinguish between rebranded mortgage funds, which are now calling themselves private credit funds, and we all know what happened to them leading into the GFC, that you've got most of those loans are real estate in some form or another, whereas a true private credit fund in the traditional sense is where you've got an institution with a truckload of money that's not bound by the rules that govern banks about holding capital. So a super fund or pension fund traditionally could lend to BHP and earn an adequate return and be more competitive than a bank.
So how is that different than BHP issuing a corporate bond, or is that effectively what they're doing?
Well, the distinct...
Or is it sits probably different on the P&L?
Yeah, well, it's
not a
different maturity,
publicly traded
different
thing.
maturities, different terms. So you might be able to you might be able to securitize a specific cash flow. You might be able to limit it to a specific project. You might be able to get longer periods.
And I think that the difference with going to the super fund that had a pile of cash for private credit as opposed to rocking up to NAB or down the road, when a business goes to a bank for credit, you are marching to their beat. They want to rock up every quarter. We want to see reports. If things not going that way, we're recalling the loan.
So they can be what they used to call covenant light, where you don't have as much of that scrutiny. But the real margin, this is really what they call regulatory arbitrage. So the bank has to follow a set of rules and keep capital. Capital costs money. So the CBA's return on capital, I think, is probably 15, 16%. So they might borrow money from you as a depositor at 5%, and then they're going to have to keep, 5% of that at 15%. So their cost of them making that loan is higher. So they want to do it shorter term. They want to have reviews so they can call it in. They probably want more security, whereas the private credit market can be a bit more flexible and earn that extra return for the lenders. So it can work in that sort of sophisticated corporate end of the market or in the special purpose vehicles, funding aircraft leases, train leases, and mid-sized corporates where you can do longer-term debts, and this pension fund needs long-term investments because they're funding long-term liabilities. And so that's a good thing. Where I think it's starting to break down is that every traditional mortgage fund is now rebranding themselves as a private credit fund.
Is that like the Latrobe?
Yeah, I mean,
the
Latrobe's
world?
now part owned by, is it Brookfield, one of the big players? But yeah, so your traditional, small mortgage fund where they were lending to largely property developers or people who couldn't borrow anywhere else and paying their customers, you can probably get 7s and 8s on small private credit today. But, do you have... And individual loans are probably a bit more transparent, but they're harder to do. You've got to do something when they mature. Lots of problems. But the general, I would clearly distinguish between real estate lending, especially property development lending, and true traditional private credit.
I just had a look to give Australian Super some love.
Yep.
Haven't received any money from them. as just disclosing this along the way. Based on the website, Australian Super's high growth option allocates 19% of its portfolio to alternatives. However, call it 10% or 9.8 is infrastructure, which is pretty boring bread and butter. 2.3 in property and 6.9 in private equity. So realistically, most people are going to have between 5 and 8% in private equity.
Yeah. So where this starts to break down is you see some super funds, who shall remain nameless, where the credit allocation gets lumped into the defensive category, which really doesn't reflect the level of risk that you're taking. Now, risk isn't bad. In fact, you have to take risk to get return, but you should know what you're getting.
Actually, this is a legitimate question. I'm pretty sure I think it's Australian Super. If I'm wrong, it's on Google, I apologise or whatever. Or it might be Rest. One of them, for their growth portfolio, the minimum suggested hold time is 12 years. We're against the VDHG at 90%. Bread and butter listed, minimum is 7 years. Same asset allocation-ish. What is going on in that portfolio for them to say 12 years minimum?
There's probably a lot less liquid. So there'll be...
So it's an unlisted asset play?
But,
because honestly, when I do all these super comparisons, like I did a slide on an Instagram reel the other day, give us a follow on Instagram if you want. Two of the big funds, their minimum hold time suggested 12 years.
Yeah. And obviously it's in their commercial interest for you to stay longer.
Absolutely.
But as a general rule, the thing about volatility, which is risk or uncertainty of outcome, is how you measure it, that the higher the growth proportion you have, the higher the spread of potential outcomes is going to be. And the longer you hold something, the narrower that gap gets. So if you have... if you think about the Australian share market, it's annual average for 125 years is about 12%. If you put $1 in on the day of Federation, you'd have earned 10%.
What was the weather like that day, Vince?
I have no idea. But the worst year was minus 62. Best year was plus 42, or the other way around. And so which years you pick. But if you look at the spread of 10-year or 20-year returns, it's much, much narrower. And that's what that holding period's getting at.
And do you think it's also a risk mitigation? Yeah. Hey, we told you guys.
We told you, yeah.
So I just Googled Australian Super high growth investment objective to beat CPI by more than 4.5% over the medium to long term. What do they say is the medium and long term? Don't know.
7 to 10 plus would be me. Will be my definition of what medium to.
Well, but then they say the objective is also to beat the median growth fund over the medium to long term. And there's a little hashtag. What's that median growth fund? As determined by the relevant super ratings fund crediting state survey. Yeah. So
that's saying we want to be in the
top quartile or
top half,
whatever it is.
Top half of funds with comparable asset allocations.
Yep. And then the minimum suggested investing time frame, at least 12 years.
Yeah, I wouldn't disagree with that sentiment.
The balanced fund, at least 10 years. I don't know, my spidey senses go off a little bit, knowing that ordinarily, people just need to know what they're getting in bed with.
Yeah.
Ordinarily, if I buy VDHG, liquid, all listed, they say 7 years. Awesome. There's just something stickier.
Yeah. Well, there'll be a 25% or more of those investments will be in unlisted assets.
Oh, no. Okay, this is interesting. Risk level for a time invested, short term, Australian super say less than 5 years.
Okay.
Medium term, this one blows my mind a bit. What do you reckon their time frame for medium term is?
5 to 10.
That's cute.
Well, you said less than 5 is short.
Yeah, that's
What
right.
were they thinking,
But
5 to 12? For medium,
keep going.
15?
Keep going, Vincent.
20?
20.
5 to 20 is medium.
Medium for them.
Which it sort of is in the context of a retirement plan, but that's
Long-term,
not what most people would mean.
Long term, more than 20 years.
Mm-hmm.
When I talk about in our investing long term, for most people on the street, I'm talking 5 to 7.
Yeah. So we would generally look at short being 3 or less,
Yep.
medium 3 to 10,
Yep.
and long term 10 plus. But they're all sort of arbitrary. It's really around.
Because I don't think those terms are pinned to
It's just
an
like
APRA.
it's just like balanced and growth. Like really.
So I'm looking just for people if they're like, why are you having a go at Australian super? You know,
Because
is
it's Australian and it's
it
super.
was. And they're like, why haven't you talked about a fund that sponsored the podcast? All right, well, I've just pulled up the ART website. Their growth fund, they are saying minimum hold time 7 years at least. They're saying they want an objective of CPI plus 4%. And so I think that's the difference here. The Australian super, it's got nothing to do with alternative assets or whatever. We're here.
It's pretty alternative though.
Australian super, hold it for 12 years. We want 4.5 above CPI. ART are saying, hold it for 7 years at least. We want 4% above CPI. So it's just everything's a trade-off.
It is. And I think that's largely a bit of a risk mitigation that it says, look, we told you this was long term.
But that's a soft marketing risk mitigation.
Yeah.
And I'm just seeing what
Or reputation risk.
reputation. It doesn't say what they say is medium and long term.
But I would expect that 80, 90% portfolio should be delivering you CPI plus 4 over the long term. But obviously
Anyway.
there's years when it won't.
All right. Well, let's.
But getting back to
yes.
alternatives, if you look at
Back
things
to the cricket.
When non-institutional investors start thinking about alternatives, you get into Beanie Babies and Pokemon
Hobbies.
cards and
Hobbies.
fast cars. Hobbies, yeah. So things that give you some intrinsic pleasure above and beyond the financial return.
Well, I like it when
Wine is a good example.
I like when you talk sexy to me and say intrinsic pleasure, but we'll be right back after this.
If you're after personal financial advice, don't get it from a podcast. But if you want guidance tailored to your situation, head to moneypodcast.com.au and click Get Help. We'll connect you with one of our trusted professionals, financial advisors and mortgage brokers, who work with people right across Australia. No matter where you are, they can help. Now, before we get back to the show, a quick reminder to protect your financial life. That means having income protection sorted. It means having death cover if there's any debt or dependents relying on you. It means getting your personal insurance in order. Most people insure their car, they insure their house, but what about themselves? Sky Wealth, who support this podcast, are specialist financial advisors who can help you get the right cover in place. Their advice is often more comprehensive and better value than going direct through your super. Book a complimentary 15-minute chat at sky.com.au. That's skye.com.au, and they'll point you in the right direction.
Sexy investments. So you mentioned wine,
fast cars.
art. Okay, do you remember?
Whiskey containers.
No. When self-managed super funds really took off in 2010s, correct me if I'm wrong. I'm wrong a lot of the times.
Surely not.
People were buying racehorses.
Yes, yep.
In their super fund.
Yeah, racehorse syndicates were a big deal. I never
Yep.
did one, but they were certainly very common. I used to work with a leading SMSF specialist who shall remain nameless, who was a big
I could remember.
a big horse fan.
He was at every road show, was he? No. Anyway.
I don't know, but he had a a personal ambition to be a colourful racing identity.
Interesting.
I think he was joking. But I used to have a lot of clients with taxi plates in their super funds, self-managed super funds, which was an absolute winner of a deal at the time.
So, but that's all kind of been reined in. So for like art investing,
yeah, you can't hang it on your wall.
You can't
hang it on your office wall.
You can't put it in your house.
No, or your office.
Or
you
your
could
office.
You could lease it to your office, I think.
And it moved under the, didn't they say a percentage now of those type of investments?
It's probably pretty hard to sustain a rational investment strategy that would be 100% fine art.
So in your self-managed super fund, you can basically buy anything. Broadly anything.
As long as you don't buy it from yourself.
Yeah.
And that you don't take pleasure in it.
Yes. So in theory, if you bought a bit of art from your super fund, put it in your house, you've breached the rules of
you could buy
preservation.
it and have it stored in a
storage facility.
Yeah.
Yeah, but you do not look at it before you retire.
Right. You're not allowed to take pleasure in it. See, the CIS Act was written by Catholics.
What else? So self-managed super fund. So there was the racehorse thing.
Cars.
Cars.
Was a big one.
Yeah. And you weren't really allowed to drive them. You could take them to like a show.
Yeah. You can't anymore.
Yeah, because they really turned the screws up on that.
I don't know if that means it was the good old days, but you know, that I know plenty of people who've made good money out of buying classic cars.
Yeah. But that's where it kind of, here we go. It was the in-house asset rule.
Which is 5%.
5%. Yeah. You are restricted from having in-house assets that comprise more than 5% of the market value of the self-managed super fund. Question. I don't know if you know, I actually need to do an episode with this. I'm going to get probably Liam Short on.
Yep. Another Irishman.
Little Irishman. He's a self-managed super fund expert. Can you buy a business within a super fund? There's no reason why you couldn't.
No reason we can't.
Maybe I need to.
Running it's pretty hard though.
That's right.
Because of the, how do you get paid to do it? Is it a contribution?
Yeah. And that's the difference. Like, yes, you can because you can buy shares in a company.
Yeah.
But anyway, so in terms of other sexy assets, and this is where, like, I was just having a look because I just always remember, and I've said this a million times on this show before. I had a client once, and they, where is it? They called me and they said, Glen, we've got an option to buy pink diamonds.
Mm-hmm.
I'm like, okay, I'll buy it. I'm like, well, how much do you want to buy? And they said, $60,000 worth. A lot of money.
Mm-hmm.
But they said, should we do it? I'm like, well, it's your money. You can buy whatever you want. But the question is, how much of your total pie are you allocating to that?
Yep.
And I think that's where it comes to, with this sexy type of investing, it was cash that they had in their bank account. They own their home. I think we had maybe $1 million of super that we were managing for them. So if you own a home with 800 or a ton and you got $1 million in super, you other assets and whatnot, 60 grand, if that disappeared off the face of the earth tomorrow.
Yeah. If
whatever.
Exactly. If it doesn't matter to you, then that's fine.
Now, if they then said, oh, Glenn, we want to do it, we're thinking about 600 grand. We're going to draw down 600 grand out of the super fund.
Mortgage the house and
buy.
buy.
Mortgage the house. It's like, whoa, slow down, turbo, because there can be catastrophic consequences.
They can.
With these sexy assets. And that's why I think when it comes to like your Pokemon cards, we haven't mentioned the B word much at the moment.
Beanie Babies.
Bitcoin.
Oh, Bitcoin.
When it comes to these things that are out there that are fun and exciting, I think the word hobby and personal interest enters the chat.
Yeah. And the issue with, I mean, you've been around a while. You will have seen quite a few wine and whiskey barrel scandals in investing. And, the level of information, liquidity, history of a lot of these asset classes, for want of a better word, is patchy. So you might very well find some evidence that says pink diamonds have done extraordinarily well over certain periods.
Well, I've got it here. Basically around 12% between 2004 and 2022. So if you invested 25 grand in 04, it would be worth maybe over 170 grand at the moment.
But the challenge is finding someone to buy it from you. So that might be what the market is, but what are the transaction costs? Who's the buyer? What is artificial diamonds? What's the impact on that? No idea. It's not my area of expertise. But they're the questions I'll be asking. If you like the look of them, you like the idea, it's a hobby.
And by $60,000, I think they got one little one. Like I pictured in the movie with the black velvet bag and the bag of diamonds, but it's literally like one diamond. But I think, do you have any rules of thumb for sexy investments?
I don't like having a dollar or percentage number on these things. It largely comes down to, is this going to spark joy? Is having an art collection of intrinsic value beyond its potential monetary upside? And, I know lots of people who've got millions of dollars worth of art on their walls. They might not be particularly wealthy. And if you were to do an inventory, that art could be worth a quarter of the net worth. Like, big deal. But to them, it's got value way beyond that dollar. It's this, and it sort of doesn't matter to them whether it's actually worth anything really. And that's a perfectly valid reason to do it. If you're doing this because I think I'm going to make more money out of buying art than I am about buying BHP, then I think you're looking in the wrong place.
I was about to say, with your sexy investing, the minute you do it to make it solve all your problems financially or have the big win, that's the slippery slope.
It is. I mean, my investing hobby is the TAB.
Yeah.
And I think I probably do come out on average ahead, but that's not the point.
Do you put some money on the little horses?
Yeah, I do like a little flutter on the horses.
Do you really?
Yeah. I grew up in Ireland, of course, where horse racing is a big deal.
Yeah.
And
you're over age, whatever.
Yeah.
So you fit the demographic.
So I don't read the Sun Herald, but it's, to me, that's where I get my excitement from. I don't need that sort of excitement in my portfolio. For others, buying and trading classic cars is both a hobby and a moneymaker.
Yeah, and this is the kind of the thing that I want to unpack with like people investing in the sexy investments, for example. For example, so this, not the one I've got on, but I've got the Omega Speedmaster, first watch in space.
The James Bond one.
No, it's the first, it's a Speedmaster. It's a numbered edition, first Omega in space.
Okay.
So I think 1968, it's like number X, it's got the number of it. When NASA went to space, they put the tender out for watch manufacturers. So my Omega, I have to, every 2 days, I have to physically wind the spring up because when we go to space, well, batteries could fail. So we can't have batteries. We can't have the movement thing.
Because there's no gravity.
Because there's no gravity. So it's the mechanical wind up. Now, I paid, I think, $5,500 for that watch. Now, I bought that because I love the look of it. I love the story. When I purchased it in 2015-ish, I think it was a bit of a milestone thing. I was like, I'm going to treat myself. I did something financial and I'm going to do that. I didn't buy that because I'm going to make money from it. Now, if I jump online now, Speedmaster, first Omega in space numbers.
And it's probably a reasonably liquid market. You could probably go on.
Yeah, so look, on eBay at the moment, they're pretty much between 8.5 to 13 grand.
And
secondhand.
there's a few for sale?
Yeah.
So they're not extraordinarily rare.
No. So look, so I'm here on chrono24.com.au. There's, look at them. 1, 2, 3, 4, 5, 6, 7, 8, 9. So look, there's one here for $9,000. There's one here for 7. There's one here for 9. There's one here for 9. There's one here for 9. It has increased in value, but who cares? Because I didn't buy it to be an investment. But if you were really into watches and it was a bit of a hobby, you had the money to do it and you knew what you were looking for, sure, you could go to some grandma's garage sale and pick up old mate's old Rolex for $2,000 and you know that it's like,
but that's
you're in that world.
But that's a bit more of a side hustle than it is an investment strategy. That you're buying and selling them.
I just think with all this sexy stuff, even you look at the designer bags that people are buying, apparently they increase in value. Do they? Not sure. Don't care. I don't know enough about it. But if you've got the money and you're interested in it, sure, knock yourself out. But I'm certainly not doing speculative investments like $15,000 for a friggin' bag. 1, that I don't know anything about. 2, if I've got consumer that I haven't paid off. 3, I haven't got my goals sorted. It really is that very top. When I talk about my my wealth pyramid or whatever I called it, the Glen James hierarchy of needs based on Maslow, the first kind of 4 foundations go up, and the top quartile, or the very top point, the category is like whatever, because you've whatevs. Like if you got the money, whatever, it doesn't matter. But I think when it comes to these sexy type of investments and all this, I do think if you have not got your financial house in order with the stuff I've talked about, or even got your career on track, and like, why are you spending $2,000 on a Pokemon card? Like, sure, you might get a good deal and see it and flip it, but it's like, okay, can you do that every week? Is it a legitimate side hustle? And I was even thinking, do you have any private equity investments like yourself?
Not apart from Life Sherpa.
So you remember that risk startup Life bid?
Yeah. Did you put some money into it?
I think I threw $5,000 in. And then I threw, I think, $3,000 to $5,000 in another.
You in advisor ratings?
No.
A lot of advisors went into that.
No, I didn't do it. It was a cleaning product thing. I forget the name of it. It's in my. But the more I was thinking about it, it's like Life bid came up. I know the financial advice industry. They were doing a raise. I heard they were at a freaking conference and bought the lanyard pack. I'm like, are we really spending money on lanyards when we should be getting the product? Anyway, it's another. But like, I was thinking, I invested in that specky / alternate / whatever it is with $5,000. Number one, I might see that money again in 10 years or never again. Number 2, if that does go to the moon, it's probably not going to be worth $500,000. You know what I mean? So I think with all this, because we see these stories about, they started Instagram and it went to multiple $1 billion and all the founders got all this money. The more I think about it, with these kind of specky investments, and I'll talk about Bitcoin and crypto in a minute.
You're not suggesting that's specky.
Maybe some coins are very specky. But I think the thing is, the minute you step into one of these sexy investments for it to solve all your problems and make money and fast, that's called gambling and dopamine.
Yeah.
Go down to the pokies. Get it out of your system.
Yeah, well, I mean,
I might do that later myself.
Whatever your poison might be.
Whatever it is.
Yeah.
Because even if the cleaning product, I forgot what it's called.
Oh, ShamWow.
No. It was
Big Kev.
no Aussie cleaning startup.
Was this an eco startup?
Yeah, it was one of those things. I forget.
Was it crowdfunded?
Pretty much. It was through like one of those Equitize.
Oh, okay.
Anyway, like I put $3,000 in that. I don't even know, 3 or 5 grand. I forget.
I mean, that's a nice punting parcel.
Yeah, I mean, it's just like,
It's a watch.
Personal interest.
It's a
Yeah,
watch.
it might come back. But when we talk about crypto, I think there is a case, like I personally own Bitcoin. It's the only reason I do is because I'm genuinely interested. It's pretty small percentage of my net worth. It's in my super fund. So if it does go to the moon, well, that's cute. Can't touch it. And I've got a guardrail in place on that. I'm not investing in Bitcoin to solve all my problems. So I really want to encourage people, put money in whatever you want, but be very clear that to build wealth for you for the long term, it's this funny thing where it's like, well, what's kind of works for a reason.
It does, yeah. And you can't always be going for sixes.
No.
You have to hit a few singles and a few...
Like I got a phone call once, I've shared it on this podcast before, and I had the offer to, and this is half the problem with this pre-IPO and angel crap. It's be able to get a phone call. I had a phone call, hey, there's a pre-IPO. Do you want to put some money in it? I'm like, all right. I threw 10 grand in it or something like that. Within 2 weeks, it was up 750%. Do you think I was waiting around to like see if it goes more? Like, no.
To the moon.
Got my cash and got the hell out of there. Like, sure, there's no CGT discounts or whatever, but I'll do those type of specky plays.
Yeah. But the challenge with those sort of specky plays, though, is that you'll get less of the good ones than you do of the bad ones, that you're more likely to get a bigger allocation in a dud than you are
because
to
the allocation has already been taken up by
Yeah.
big players in the good stuff.
Yeah. And so that's why investing in IPOs is not particularly profitable, because unless you're on the inside.
I had information that wasn't insider
No,
trading.
I don't mean
Yes.
insider
Yes.
in the illegal sense.
Yes.
I mean within the distribution network. So the investment banks who support underwrite IPOs, they will have a network of people they know they can rely on. And when they can't, then they go further afield. So if you're getting a big allocation in an IPO, it's probably more likely to be a dud. And therefore, on average, you're going to do worse than the average IPO.
Yeah, so it really doesn't matter what the sexy investment is. Number one, take interest in it.
Well, that's the main reason to do it, I think.
Like, we're not doing it to solve all our money problems.
It's conceivable that it might solve your money
It might.
problems.
Pleasant State was the company, the cleaning company.
Never heard of it.
I need to get them on the podcast.
So, yeah, and this is partly where the core and satellite concept gets abused.
I love when you talk dirty to me.
Taken on by every huckster in town to sell every dodgy investment, where they go, oh, this is, you've got your core sorted. Now this is a satellite.
Yeah, throw it out with the trash on a Friday.
So to my mind, if it doesn't fit in the core, it doesn't fit in my portfolio. And that my TAB habit is outside my family fortress.
Yeah, and I think that we have to decide, it's like I'm doing my wealth building and my investing here. I'm not dicking around building my own portfolio where a lot of people do. Like just use Life Sherpa Invest, I don't care. I just focus on shoveling the money in,
That's right.
let the portfolio do its thing.
And for most people, they'll be better off spending that time on their day job, which is the source of the wealth for most people, and rather than dicking around trying to think that you can get one up on Wall Street. Because the answer is you probably can't.
Yeah. I mean, I would like to potentially buy, if we talk about sexy investing, like an older car. But it's just, I'm not in that
But an
world
older car
enough.
for you is about 6 months old, isn't it?
Yeah. You know it. Because I just want to, I don't know, it's this FOMO, isn't it, really? Like, I want to be in on the next big thing.
Yeah.
And I think that's my Bitcoin allocation, I reckon. It's probably like, I'm just going to be so pissed off in 20 years when it's $1 million a coin, or I just didn't put some money in it then. I think that's the rationale for my Bitcoin.
Yeah. I don't
Now-
think there's anything wrong with having a punt.
I have dicked around with
But I don't
meme coins.
think I was buying the Melania coin or the.
Melania. Did you buy the Trump coin though, Vince?
No, I did not buy the Trump coin or the Doge coin for that matter.
So I think I got on the Trump coin wave.
Did you?
I threw 10 grand in it. Threw 10 grand in.
Did you make money?
Giddy up. I was out before it tanked. Yeah. But literally I got in the minute it was announced.
Okay.
And for me, you know, and I'm not saying everyone go and buy meme coins. I'm saying I categorically, you know, I'm always looking at crypto and meme coins. I don't hold any right now, only the Bitcoin. I saw that the Trump coin was announced. Literally, I remember I got straight in 10 grand, which is a lot of money for a lot of people, but I categorically knew that the way these meme coins work, they literally go to the moon, and then it's only a matter of time the show is over. So it was literally a punt. It was no different than me taking 10 grand down to Crown or the Star.
Yeah. And that's a
But
perfectly
I
legitimate thing to do.
But number one, if I lost that $10,000, my life wouldn't have been impacted. It's not like I didn't go, going to get $358,000, going to do that, and like that's a high. But if I watched blackjack tournaments online and I was really into that or whatever, once every 5 years I took 10 grand down to blackjack, had a punt. Maybe I tripled it. Maybe I didn't. But the problem is when you dick around with speculative and sexy investments, the downside risk of getting absolutely flushed and destroyed is so much more catastrophic than it 10xing in your life.
And sometimes having an early win is really bad because now you think you're God's gift at crypto trading.
That's right. And that's why I haven't been – I think I did one other meme coin, and this was hugely online, and I've talked to a lot of people that didn't even know this. It's probably just my algorithm. When I think it was the end of last year, there was a meme coin, the squirrel in the US. Forget the squirrel's name. What do they eat? The nuts or squirrel? Something that's squirrel.
Acorns is the big thing.
No. It was Peanut the squirrel.
Oh, okay.
So there's this big thing in America where in New York City, a man had Peanut the squirrel as a pet.
Okay.
It was a baby squirrel that he bought, had it in his apartment or whatever. He got an order from the New York City Council. This is a loosely paraphrasing thing. He's got to get rid of the squirrel, not allowed to have a squirrel pet. They euthanized it. So the whole thing online was Trump was going to save Peanut the squirrel. Trump was treated badly. So anyway, someone made a Peanut the squirrel. I think the code was PNUNT. Peanut the meme coin. Again, if I'd seen this after it was being out a week, I wouldn't have bothered. But I woke up, my friend, co-author Nick Bradley goes, "Did you see Peanut, the meme coin?" I'm like, "No." Had a look at it, literally 3-4 hours old. I put, I think, $1,000 in, and this was before the Trump coin. I'm like, I'll just throw $1,000 in. Went up. I think I made $3 or $4 grand. Got the hell out. I'm not saying.
Did it crash?
Oh yeah. Oh, absolutely.
Completely.
But I only did it. So these two examples where I got in on these sexy kind of, I call them smash and grabs, was because I understand the nature of these meme coins, where it's like you've got a 3-day window, if that, really. And it literally is a smash and grab. The whole reason I doubled down with the Trump one was I knew that Trump, it's worldwide. This is, I'm literally in very, very early. I'm like, let's go in. And then I got the hell out. So, but each time I was doing that, it wasn't like, I'll take a quick win. But like you, if you have a flutter on, race 8, horse 3 or whatever, you're not doing that
I'm
to
usually
solve,
gone by race 8.
You're not doing that to solve all your financial woes or problems.
No.
You're not allocating a monthly amount into the Vince Scully tab account. It's probably just discretionary.
I do actually. I put a couple of $100 a month into my account.
Here we go.
But it is a couple of hundred.
But it's a hobby line item for you.
Yeah, that's right. It is no different than buying books or going to the movies. It's just a couple of $100 into the online account, go to Randwick now and then and have a punt. I wouldn't say I make much money, but I don't lose. I certainly wouldn't lose all of that.
But
and
for
it's
you,
a great debt.
That's an entertainment line
This is
item.
pure entertainment.
And that's what I'm saying.
And it stops me doing
the big dumb stuff that I do.
Well, the big dumb stuff that I used to do. I used to trade small oil stocks because I knew something about oil, which is a really dangerous thing to do.
But this is the thing, like, I don't know. So I don't think I've ever had dry powder yet, fingers crossed, and put it into a specky that I've lost the money. However, the story isn't over because Pleasant State, Life Bid that I've put money in, and these aren't huge amounts of money, like less than 10 grand for those 2 little startups. That story's not over. In 10 years' time...
So have you marked to market?
Sorry?
Have you marked it to market?
No, I don't want to. But, but with these little smash and grabs that I've done, like the pre-IPO, actually I had one. I bought convertible notes in a company that was going to list.
Oh, yes, I remember this
We won't
story.
say the names.
No.
I put 25 grand into this convertible note. And basically a convertible note, everyone, it is basically a contract or a note, if you will.
A bond.
Certificate,
Yep.
a bond. I said, yep, here's $25,000. The convertible note, and I would say this is a sexy alternate asset, and I did it for the fun of it. I'm interested. And I understood the world and how it worked. And they say, okay, so you've paid for this note, $25,000. In 12 months, it will convert into $25,000 worth of ownership in the company when it lists. The trade is, if we don't list by 12 months, we will pay you 10% annualized interest repayment on the 25 grand.
Yeah.
So when you look at it at face value, it's like, oh, yeah, I'll throw 25 grand in. The worst case scenario in a year's time, if they're not listing, they've given me 10%.
Or they've gone bankrupt.
Or they've gone bankrupt. So but what happened, and this is a story where it kind of didn't work, but it kind of did as well. They said the company's not actually going to list anymore. We will give you your money back if you want, without interest. Okay, so this was the fun part. Like, I love the hustle. Said, it's been 12 months. It's not listing. We've got two options. We can give you the money back without interest. I'm like, yep, give me my 25 grand back. And they did. Or you can keep the convertible note, but knowing the entity that wrote the convertible note is now a shell company with no revenue that will ever happen, blah, blah, blah. So I did lose out potentially.
Opportunity cost.
Opportunity cost of maybe that 25 grand over a year getting 5% return. So, but I think for me, in that Maslow's hierarchy vibe, these little bits of dry powder that I put in, I 100% understand the risks. I 100% understand that I could do my ass.
Yeah.
Is it? It probably is gambling to us, the way that I do it, because it's certainly not investing. It's a smash and grab.
And you had no real ability to do any due diligence on that.
No.
There was probably an offer document that you could read.
Yep.
And you probably got bored by fourth paragraph.
Or third paragraph. Yep.
And
But I knew the overarching company.
so it's a punt.
So
Nothing wrong with taking a
It was
punt.
an educated punt. So that's probably another risk. I'll tell you offline, Vince, for the sake of time. But I don't know. I just wanted to. I'm a huge believer. Like, I will have a run at a specky, put some money behind something unlisted any day of the week. One, if I've got the spare cash.
Yeah.
Two, if it's not earmarked for anything else. Three, if it literally disappears tomorrow and I never see it ever again, it's not going to ruin me financially.
Yeah. And I think, it makes me a bit academic now, getting back to the original topic of the podcast, but the concept of why you should add alternatives to your portfolio, which is this going to add value to your portfolio? Is it going to do something that means something in the overall context of your portfolio? If the answer to those questions is no, then it has no business being in your portfolio. Does that mean you shouldn't do it? No, it doesn't. It means that it forms a different role in your life, and treat it that way. That's probably the message that I would leave anyone with.
Yeah, and for me, the speccies and the sexy stuff, whether it's watches, I'll show you, you've probably seen them before. I've got some actual gold coins at home. You know, the 99.9% solid gold. They weigh a lot.
Yep.
They got the face value.
And they're nice, pretty to look at.
Yeah, it's like I get it out of the box sometimes, and a few of the other coins, and the face value of the coin, and it's Australian tender, so it's like $50 or something.
Yeah, just don't take it down to the shop and sell.
Like, I could take it down to KFC and buy $25 worth of chicken. They would have to accept this $2 coin. It's worth probably close to $2,000 in actual gold. But why did I buy that? One, it's an interest to me. Sure, it's a privilege, it's a luxury, it's all this crap, but I'm into it.
Yeah. And it feels a little bit more tangible than a gold ETF, which is how we invest in gold.
Yeah.
But, keeping it around,
But I didn't,
trying to find something to buy
these coins as a quote-unquote investment in gold.
Yeah. And
It just happens
that's
I'm
the
interested
difference.
that it's real gold and I've got some. But like Sim, for example, from Girls That Invest, who you've met, I'm pretty sure she purchased one of those Hermes handbags as an investment. Could be wrong.
Like a Birkin bag or something.
Yeah, exactly, yeah. I'm just not into handbags, so I'm not spending $20,000 on a bag because I don't understand it.
I must admit, every time I hear that expression, girls that invest, I hear my high school English teacher in my corner going, girls who invest.
Slap. To be fair, Sim knows that it's not grammatically sound.
Well,
and she was
apparently it's perfectly acceptable now.
Yeah, and she's like, oh, I should have. She goes, I'll just.
No,
go
I
with
think it rolls off the tongue much better.
Yes.
And I just hear the voice of my
that
English
is
teacher.
an object. Who is a person?
Yeah.
Is that the vibe from your
it's the
English and Latin teacher?
The distinction, I think, is a description of a class of people. So if I'm going to say the boys in this room who invest, but I could say Australians that invest. So it's sort of changed a little bit, but it's about whether you're distinguishing, trying to identify who the individual girl is as opposed to the overall class of girls that invest. But it's just one of those things that I hear the voice of my English teacher in my ear every time I hear it.
Young Vincent.
Yes, and that would have been an occasion where he'd use my full name.
Oh, speaking of which, have you watched the show on Paramount Mobland?
No.
Pierce Brosnan's in it
Oh,
as
okay.
the gangster boss.
Okay.
He does a terrible Irish accent in it.
Despite being Irish.
Yeah. Like, honestly, because he's more British than Irish.
Yeah.
That's weird. And it's just because he's obviously hasn't had the Irish accent for a million years, right? But his Irish accent that he puts on, I don't think it's great. But
have you seen that Liam Neeson in Ted, where he goes to the shop to buy the box of cereal?
No.
It is hilarious.
But anyway,
I'll share it with you.
We're outstaying our
Anyway.
welcome. I'll just run a mid to ad right now, and we'll bring it home right after this. Thanks for letting us pay the bills. Covered a lot of ground. I've probably overshared, but I hope
That's not like you, Glenn.
people meet me and they're like, I feel like I know you. I'm like, you do. There's not much I don't share. But when it comes to sexy investments, whether it is your Pokemon cards, whether it is fast cars, whether it is artwork, whether it is wine, I just honestly believe the real kind of sexy investments, you're more likely to make money from them if you're into that world. There's probably a better chance of me making money doing a smash and grab from a meme coin than my friend Dirty Mike, who's never purchased crypto in his life. Fair statement?
Yep.
Because I see it, like if he opened a crypto account tomorrow, started just looking at random coins and all that, he might struck it lucky. And this is me saying, I've just been lucky. There's a chance next time if I
You could be
decide to do
unlucky.
on smash and grab, I might do my ass. And that's why I'm self-aware enough to know that, no, this isn't a permanent thing where I just keep putting money in it.
You're not a crypto legend because you made two.
No, that's right. Where buy and hold Bitcoin for the long term, yeah, I'll buy it. I'll eat that all day long. I'm literally tempted to put some money into Solana.
Yeah. And of course, the knowing when to sell is actually 9/10 of the exercise.
And this is it. Like, this is the whole, and we might finish with this. This is a really good example. These shows on TV where they get to the last round and like, Vince, you can take the $10,000 now, or you can play on for the $100,000. What do you want to do? And it's like, I'll play for the 100. I think it was Outliers by Malcolm Gladwell. He did the story of the guy smartest guy in the world.
Oh, the guy who won the...
No, it was a story of the smartest guy in the world when he went on Who Wants to Be Patronised by a Millionaire. Not the Australian version, but
Lock it in, Eddie.
Yeah. He got to the second last question and said, I'll take the 750. Because he was smart enough to know that, one, I literally walked in here today with zero. Two, why are we risking so much money to get a little bit more when it's, a bird in the hand type vibe?
Yeah, and knowing when to quit.
And that's what I've resolved when I do my odd little smash and grab. I'll buy, if I throw 10 grand into a Trump coin and it goes up 90% or 80% in 12 hours, step back.
Bank it.
That's a lot of money. That's a not normal return. It's not, keep going.
Take the money and run.
Like, you have to know that you're an idiot and you don't know anything. you've got 80% more than what you had yesterday. What the hell are you doing?
Yeah, because
Get
the
out of there.
temptation is, well, I never had it, so I'm not going to miss it, so I should let it run. That's when things get out of hand.
Or I go, I'll take my original capital out,
Yep.
leave the rest to run for another day. But look, whatever you do, you just need to know that any sexy investment, whatever that is, knock yourself out. Just maybe know that it's probably not going to change your life.
But it might.
But it might.
So when you buy that lotto ticket, you might actually take home the $10 million.
A listener of this show, I shared on the podcast, they won 30 million Powerball. And I've been talking to them, referred them to a financial advisor. We'll end it there.
Yep.
So they told me some interesting comments about some of the private banks that were quoting them. And I think it was borderline gouging.
But anyway, and they're not sponsoring the podcast.
No.
So maybe we should thank the sponsor one more time and say goodnight.
Oh, and who would that be, Vince?
Oh, Life Sherpa Invest.
Oh, there you go. So, yeah, if you want to see what I invest in, you can have a look at the Denali portfolio on Life Sherpa Invest.
Aren't you in the Everest?
That's the most extreme
Yeah.
one? No, I don't do that.
You don't do
I'm
that.
not a risk taker, Vince. So what am I in the Denali 80-20?
The Denali's the 80, yep.
80 is, yeah.
Kilimanjaro 70 and Kosciuszko's 50.
Yeah, and the Everest is 90-10.
90-10.
So you don't have a 100%.
Nope.
No. And that's it, like,
Well, because the risk-reward trade-off just doesn't work.
but this is interesting, isn't it? When you look at sexy alternative venture capital, for me to say, for my regular bread and butter super contributions to go into an 80-20 portfolio, right?
Yeah.
I'm not prepared to do a 90-10 because I don't see the difference on balance. Like I don't care for that volatility month on month.
Yeah. So the difference between...
But this is coming out of the mouth of the guy that put 10 grand into a meme
Yeah.
coin. Like
well,
psychology.
they're different mental buckets.
That's right.
Yeah.
And that's the psychology of it.
Yeah. But on that, talk about the difference between that 90, 10 and 100. To get to turn that into a 100% equities portfolio, you'd have to take the gold out, and over the last 20 years, you'd have had higher volatility and
less
lower
return.
returns.
Yep.
That's not a good trade-off in my book, which is why we don't offer 100.
Yep.
That, if some is good, more is not always better, and 100% of anything is rarely the right answer.
I just think we need to avoid catastrophic risks. I wrote in the book Sort Your Career Out
Sort Your Career Out.
about taking risks, and we do need to take risks, but when or possible, we need to avoid catastrophic risks. And an example of that is you look at the numbers with Russian roulette. If there was a 5-chamber revolver, there was one bullet in there, there's a 20% chance you're going to die. Yeah, but there's 80% chance I'm going to live. Oh, would you play Russian roulette to get $1 million, Vince?
No.
No, I'm not playing that. And I'm not playing it for a 1% risk of it happening because it's so catastrophic.
Yeah.
And guess what, Vince? A 1% chance of things happen all the time.
They do. Ask all those people in Lismore who live in the 100-year flood.
Absolutely. So I just think we avoid catastrophic risks, but with our investing, for me, avoiding a catastrophic risk with speculative crap, like I'm not going to buy 100 grand worth of Omega watches tomorrow to have in my cupboard. Not doing it. Got a nice watch I'll wear. But for me,
and the one you're wearing.
Yeah, well, this is the Swatch one. It was the $400 because Swatch purchased Omega.
Oh, this is the
the
joint venture thing.
Yeah, and
okay.
they got it's really cool. I'm like, this is amazing. Why don't I do this? I get it's a Speedmaster and it's orange and it's awesome. So, yeah, if you can see that on YouTube, I love it. It's like, I can scratch the itch for $400, not $5
Maybe
grand.
you need to get them on as a sponsor.
But I think avoiding catastrophic risks for me was more, well, I'm not putting more than like 10 grand in a meme coin. That's crazy. But it's catastrophic if I'm like, I'm going to put 300 grand in that because that's ridiculous. Because the upshot of it going to the moon and me getting $5 million, not worth me losing 300.
But the punt of buying a $10 lotto ticket, downside very small, tiny upside of massive.
But that's not a catastrophic risk, buying a lottery ticket.
Correct. That's what I mean. It's you might have a tiny fraction of winning, but the downside is largely academic.
I think buying a lottery ticket is a catastrophic risk potentially if you decide I'm putting $1,000 a week on lotto. Because that's got real life consequences.
Yeah.
Where you might not notice $2.50 a week, but you probably would notice $1,000 a week.
You would.
I don't know if we've solved any problems today, and so much for we'll do a quick 35-minute. We'll see that, an hour and 36 over there.
Oh, my goodness.
But hey, it's been real.
We can rebrand it as a deep dive.
It's a borderline campfire chat.
It is almost.
I'm going to put a campfire chat because it has been a bit of a campfire chat, and it's a Tuesday episode. We never put campfire chats on Tuesday episodes, but here we are. We did. Thanks, Vince. Thanks, friends. If you've enjoyed this, if you're upset at me for spending money on watches and gold and...
Check your privilege, Glenn.
Well, if you're upset at me putting 25 grand into a specky investment, guess what? It's my money. I'll do what I want. How about that? You can do what you want with your money.
That's right.
Okay, bye.
Bye-bye now.
Any advice is general financial advice only, which does not take into account your objectives, financial situation, or needs. Because of that, you should consider if the advice is appropriate to you and your needs before acting on the information. If you do choose to buy a financial product, read the Product Disclosure Statement, PDS, and Target Market Determination, TMD, and obtain appropriate financial advice tailored to your needs. Simo Interactive Pty Ltd, the publisher of this podcast, and Glen James are authorised representatives of Money Sherpa Pty Ltd, which holds financial services license 451289. Opinions or comments from any guests on the podcast are theirs and not those of the host or the publisher or their respective license holders.